The broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome everyone to today's webinar, How to Win in a Two-Speed Economy, brought to you by Citrix GoToMeeting. I'm James Kirby, Managing Editor of Business Spectator, and I'll be your moderator today. While we're waiting for the last few people to file in, you will get a link tomorrow to this recording of this live session, and this allows you more time to listen and ask questions instead of worrying about note-taking. And to ask a question, you can type them in using the webinar control panel, and I will put them to our guests. The questions roll up on the screen, which I'm able to see from here, so keep them rolling throughout the session, and I will do my very best to answer, or at least to ask, all the questions that we receive. Now let's get started. Today our panelists are Paul Bloxham. Paul is the Chief Economist for HSBC in Australia and New Zealand, and he is joined by Saul Eslake. Now, Saul is the Director of the Grattan Institute's Productivity Program, and he is also the soon-to-be Chief Economist at Bank of America Merrill Lynch, Australia. Gentlemen, welcome to our webinar. I think we'll begin the session with, as we always do, with some presentations from both our guests, and we're going to begin the presentations with Saul Eslake. Saul, if you're ready, we'd like to start the session with your presentation, please.
Well, thank you very much, James. It's a pleasure to be here. Hi, Paul. I've just got a few slides that I'm going to whip through fairly quickly, and as James said, if people want to study these in greater depth, they'll be up on the site tomorrow. My first two slides simply illustrate the point that Australia is currently experiencing its most sustained and largest commodities boom in at least a century and a half. The first chart shows that Australia's terms of trade, though on a couple of instances, has been at higher levels than it has been in the last year or so. Those previous occasions have never lasted, whereas this upswing in the terms of trade, though it's probably now peaked, as the Reserve Bank said last Friday, is nonetheless expected to see the terms of trade remaining at elevated levels by historical standards for the past decade. And moving on to the next slide, which shows that in order to capitalize on the once in human history opportunity which the industrialization and urbanization of the two most populous nations on the planet does really represent for Australia, we're also experiencing the largest upsurge in mining investment as a share of our economy in 150 years. My next slide, however, records the sorry historical fact that whenever we've experienced an episode like this in the past 80 or so years since the end of the Second World War, we've managed to stuff it up. In particular, what I mean by that assertion is that each of the three commodity booms we've had since the end of the Second World War, the Korean War bull boom of the early 50s, the long boom associated with the industrialization and urbanization of Japan as it became our largest trading partner in the 19th commodities boom that was triggered by the second oil shock at the time of the Iranian Revolution and terminated by the Volcker shock of the early 1980s and the US recession which followed it. Each of those was associated with our three historical episodes of double-digit inflation. And even though there's been an enormous amount of structural change in the way the Australian economy operates since the last of those three episodes, we now have a floating exchange rate rather than a fixed one. We have an independent central bank rather than one which needed and found hard to get the permission of the government of the day to raise interest rates. And we don't have a system of centralised wage fixing that used to guarantee, as it did on some of those occasions, that double-digit wage rises run by mining unions from employers who could afford to pay them would be almost automatically spread over to workers in other sectors of the economy whose employers couldn't afford to pay them, thereby helping to generate this double-digit inflation despite the changes that have occurred since then. As my next slide shows, the inflation rate did get away from the Reserve Bank during what we now refer to commonly as mining boom Mark 1. The period during which the underlying inflation rate, that's the orange line in that chart there, was above the top end of the Reserve Bank's 2 to 3% target band, was by some margin the longest since the Reserve Bank began targeting inflation in the early 1990s. That wasn't entirely the Reserve Bank's fault, of course. It was partly also the result of the then government's fiscal policies in pumping up domestic demand, adding to inflationary pressures to which the Reserve Bank belatedly responded by raising interest rates to their highest level since 1994-95. But there's no doubt that the Reserve Bank is both acutely conscious of our long-term history of mismanaging the inflationary consequences of these episodes, and also, though they don't say so explicitly, their more recent history of not getting on top of that problem and in effect being rescued from a more serious failure of inflation targeting by the onset of the global financial crisis. I'd argue that each of these sorry episodes has occurred. That is, past commodity booms have generated double-digit inflation because, as my next chart shows, Australians and their governments have simply been unwilling to accept the arithmetic proposition that the sum of all the shares of the different sectors in the Australian economy as a proportion of GDP can't add up to over 100%. That is, even though it's an inescapable matter of mathematics, Australians struggle to grasp that if the mining sector is to grow as a proportion of GDP, which it clearly has to if we're to make the most of the opportunity represented by the industrialisation and urbanisation of China and India, then other sectors of the economy have to shrink, but as a proportion of GDP. Now, the chart which you've got before you actually shows that the mining sector hasn't really expanded as a proportion of GDP by much since the formal onset of this mining boom in the early years of the past decade. Rather, the increase has really shown up in the construction sector, which has expanded enormously as part of the ramping up stage of the mining boom. And as projects come into full production, obviously the mining sector will expand significantly as a share of GDP. The converse, of course, is that other sectors have to shrink in order to accommodate the expansion of the construction and then the mining sectors as a share of GDP in a non-inflationary way. The decline in the manufacturing sector has, of course, been going on now for more than 30 years, shown on that chart, but despite the fact that it's something we ought to have gotten used to, the recent pressure on the mining sector, on the manufacturing sector, seems to have generated an inordinate amount of wailing and gnashing of teeth on the part of the population at large, as well as its political representatives. You can also see from the top right-hand chart that the trade-exposed services sectors, which is particularly tourism, but also the aviation sector, have been adversely affected by the strength of the exchange rate, and there's a fair bit of wailing and gnashing of teeth going on about that. But clearly this is something that has to happen if the mining boom is to be accommodated in a way that differs from the way we've failed to manage this successfully in the past. When we look over the page at employment, at business conditions, we can find more evidence of the way these factors are playing out. The mining sector is, according to the National Australia Bank's quarterly survey, both experiencing and expecting above average trading conditions. That stands to reason, whilst many other sectors, including manufacturing, wholesaling and retailing, are experiencing and expecting below average trading conditions. But it isn't always as simple as it sounds. For example, the recreation sector, which presumably includes tourism, is actually not doing too badly by comparison with experience over the last 20 years, according to the National Bank's quarterly survey. Nor, when we look at the next set of slides, which shows employment by major sectors, is the labour market presenting a simple textbook picture of mining doing well and everything else doing badly. The financial services sector, for example, is, at least in employment terms, doing pretty well, recovering from some of the losses that occurred around the time of the financial crisis. The construction sector is certainly generating a lot more jobs. Healthcare is continuing to go gangbusters. What's striking is that retailing and hospitality haven't engaged in the intense job shedding that you might have expected them to do coming out of that sector. Of course, manufacturing's continuing to shed jobs, but I say that's been going on for the last 30 years. All of this has generated considerable talk about Australia having a two-speed economy, and that's illustrated on my next slide, which shows the spread between and the standard deviation of state and territory real gross product growth rates and industry real gross value added growth rates over the last 20 years. And the striking thing which this chart points out is that there is nothing new about Australia having a two-speed economy. Indeed, I'd argue that given the size and spread or diversity of Australia's economy, it would be astonishing if at any given point in time there weren't regions and sectors of the economy experiencing vastly different conditions from others. What this chart shows is that neither the spread or standard deviation between the fastest and slowest growing states and territories, or between the fastest and slowest growing industry sectors within the national economy, has been greater over the last 5 years than at almost any other point in the previous 5 years. I mean, of course, it's undeniable that states in the southeast corner are experiencing tough conditions, and that sectors such as manufacturing and, by some definitions, tourism and retailing are experiencing tough conditions. But the idea that some sectors are doing badly and others are doing well is hardly new at all. I suppose what's different about the recent experience is, first of all, that the parts of the country that are doing well are the ones that have the largest populations and the most marginal seats in them, whereas parts of the country that are doing well tend to be thinly populated and tend not to have many marginal seats located in them. The sectors which are doing badly, such as retailing, housing, manufacturing and so forth, are sectors on which we get a lot of data and which many people observe as they go about their daily lives, whereas sectors that are doing well, like mining and engineering construction, we only get data on once a quarter, and we don't see too much mining or engineering construction going on in our daily lives. In my view, there is not much that governments can or should do to assist industries at the wrong end of our two-speed economy to cope with the more difficult trading conditions they're encountering. The one thing which those industries should be doing for themselves, and which government should be assisting them to do, is to lift their productivity performance. For most Australian industries, productivity performance has been worse over the last 5 years than over either of the two preceding 5-year periods. The only sectors which are experiencing faster productivity growth in recent years than they have done over the previous decade are the information, media and telecommunications sectors, the professional and scientific and technical services sectors, and the administration and supports are going to need to lift their game if they are to survive and prosper during what may well be more than a decade of the present pattern of economic growth continuing. The last point I want to make, going over to the next couple of slides, is in relation to the fact of and consequences of the slowdown in consumer spending. I argue that the weakness in retailing is not fundamentally a byproduct of the resources boom, but is rather instead the consequence of decisions that households have arrived at independently, intensified by the financial crisis but beginning before then, to end the period of increasing their debt relative to their income. It's actually quite striking that although Australian households are experiencing stronger growth and haven't experienced the same loss of personal wealth or jobs that American households have done, that they're nonetheless saving almost twice a proportion of their income as Americans are now doing. And again, I emphasize that this was a trend that had begun to emerge before the financial crisis came to hit. As the next slide shows, the weakness in retail spending doesn't reflect softness in income, nor does it reflect a marked slowing in consumer spending overall. Rather, it reflects a decision by households that they're going to spend less on discretionary goods, which are often purchased with borrowed money, than they had been doing before. Spending on services is actually holding up quite well. It's spending on the kind of goods that many retailers sell that is weak, and that is another reason for the decline in manufacturing as a share of our economy. It's just that simply we're spending as consumers a smaller proportion of our income on the kind of things that manufacturers produce, and of course we're not competitive enough internationally to sell the difference overseas. The last point I want to make about this is that the sharp increase in household savings has meant that households are now a net lender for the first time since the late 1980s. Now, traditionally, Australian households have been net lenders to the rest of the economy. The fact that they haven't been since the late 1980s is one of the reasons why we've run recurring large current account deficits whenever we've had an upsurge in investment. What's striking about the most recent upsurge in investment triggered by the second phase of the mining boom is that we've accomplished it without blowing the current account deficit out to over 6% of GDP. On the contrary, the current account deficit's now running at barely more than 2% of GDP, and by the standards of the last 20 or 30 years, that's an extremely low figure. Going forward, if households continue to save a high proportion of their income, that will make managing the mining boom a lot easier than would be the case otherwise. Let me finish on that point, because I probably
thank you, Saul,
time, and hand over back to James.
Thank you very much, Saul Eslake, which we would expect from you, Saul, and some very interesting points which I'm sure will come up later in our question and answer session, particularly your idea that there has actually been a two-speed economy in place for a long time, and the notion that productivity is perhaps the way out for those at the wrong end of this two-speed economy. And I can see quite a few questions on productivity already appearing on the screen. So we're looking forward to getting to this question and answer session. We want to have one more presentation, of course, before we do, which is from Paul Bloxham, the Chief Economist for HSBC in Australia. Paul, would you like to start your presentation, please?
Thank you, James, and thank you, Saul, for your presentation. There was a great deal of material covered there, and in some ways a lot of my slides actually look fairly similar to Saul's, so I'm going to try my best to not end up repeating too many of the points that he's also made with the same sorts of slides, and try and find those areas which my view differs a bit from Saul's. If you flick to the first slide, as Saul pointed out, this is a once in our country's history rise in mining investment. This is by far the largest rise in mining investment we've seen, and this increase in the share of mining investment in the economy really does mean that other parts of the economy need to slow down in order to make way for it. In fact, that's exactly that is almost by design. One of the key things that has managed to make this happen this time around, as Saul pointed out, is the floating exchange rate, but also the independence of the central bank. My point of emphasis really through these sets of slides is that the exchange rate has really done a lot of the work for us in terms of making that adjustment in the economy that really is necessary given the rise in the terms of trade that we have seen. So if you flick to the next slide, this shows the Australian dollar against the US dollar in nominal terms, and it shows it right back to the beginning of the century. Of course, we had many different exchange rate regimes through those periods, and they are different to the floating regime we've had since late 1983. But the key point here is for the Aussie dollar to be up at the sort of levels it's at is not historically unusual. It's unusual relative to the recent history, to Australia's recent history. And given the big change in the world that we're seeing in terms of the shift of the global economy's centre from the west to the east and the increased influence of Asia in terms of global generating global growth, it doesn't seem unreasonable that you might expect that the Aussie dollar stays at very high levels into the future as well, certainly relative to the period of history we've seen over the past 20 or 30 years, and indeed that is our expectation. Now, along the way, while this exchange rate has appreciated as much as it has over recent times, that of course has slowed down some parts of the economy that are very to the exchange rate, at the same time as allowing other parts of the economy to grow, and in part allowing a lot more imports into the Australian economy and a lot more of a transfer of the sorts of demand from inside the Australian economy to outside the Australian economy in the form of things like increased overseas tourism, both by local residents and also by less people coming here, and of course we've also seen a shift in demand for goods to overseas because things are a lot cheaper in Aussie dollar terms. So the key point here being that the exchange rate is a key and fundamental reason, a relative price that has shifted in the economy that has allowed the economy to continue to grow through this period without the sort of inflation that we saw earlier in terms of Saul's chart. It also really does set the scene for the sorts of industries and the sorts of challenges we face in terms of the areas where you might see, you might be able to take, you can see a pickup in the economy or strength in the economy in the future, and thus take advantage of the two-speed economy. That is, you have to really take into account that the Aussie dollar looks as though it is highly likely to be quite strong and around potentially and around parity over the coming years, and you need to take that into account in terms of the business models that are obviously going to show areas of prosperity. So this is the key and fundamental point. I think the exchange rate has been a key a driver of the changes we've seen across the economy, and if you can come up with, and of course some business models don't deal well with the exchange rate being around parity, having averaged around 75 cents against the US dollar over the float period. So that adjustment is taking time. That is slowing some parts of the economy down while other parts of the economy speed up. But as time goes by, of course, the business models that exist do shift and do adjust to that new level of the exchange rate, and as they do, that will spring more opportunities in those areas for those businesses that are able to adjust. If you flick to the next slide, this somewhat is a slightly different approach to capturing a similar theme to the one that Saul pointed out, which is effectively just taking the nominal economy and taking away the mining investment boom. That's the black line. You can see that the part that isn't the mining investment boom actually needs to be the smallest it's been in our history. And then I've gone one step further and taken away estimates of the public sector, and based on the budget, what the public sector will take up as a share of the nominal economy. And you can see in the red line that it is the case that the non-mining private sector actually needs to be its smallest share in history. So it shouldn't be surprising if other parts of the economy that aren't really directly affected by what's going on in mining are actually feeling sluggish, and that's of course what we're seeing. If you flick to the next slide, it's an aggregated version of the one that Saul showed in the NAB business conditions survey on a quarterly basis, and the other industries averaged together. You can see that the mining industry is they're very happy about things. Conditions are very strong. In the other sectors, things are not as weak as they have been in previous downturns, and certainly nowhere near where they were in the 90s recession, but they are nonetheless a bit below their average level, and as you'd expect. I've got a couple of slides now pointing out particular industries that have been weaker. If you flick to the next one, manufactured exports, or the manufacturing industry, is one area where things have been under a fair bit of pressure due to the strength of the Aussie dollar. It is worth pointing out that manufactured exports have actually continued to rise nonetheless, despite the strength of the Aussie dollar. In part, this reflects that a lot of what we do in manufacturing is actually processing minerals. About a third of our relatively small manufacturing sector is processing minerals. So if you think that 7% of our economy, 7% of value added is manufacturing, and that around about a third of that is actually to do with processing minerals, there isn't very much left in the manufacturing industry, but nonetheless it is the case that that part of the economy has been under a fair bit of pressure. Another area, if you flick to the next slide, that has been under a significant amount of pressure has been tourism. The strength of the Aussie dollar has meant that, of course, more Australians travel offshore and less foreigners come here. Indeed, those black lines show the net swing in tourist numbers. It was the case 1 decade ago that you had a net flow into Australia of around about 120,000 people on a monthly basis. It's now the case that you have a net outflow of about 120,000 people. And indeed, that swing, a large part of that swing, has happened in the last year. We've seen a 45,000 person swing in the past year. Now, there is sketchy math in terms of working out how much tourists spend in Australian stores, but the surveys that are available suggest that they spend about $3,000 to $4,000 when they visit here. If you scale up those 43,000 people by that number, you come up with a number that's effectively between 0.5 and 3/4 of a percentage point of retail sales. So I guess one of the themes that I've sort of built is the exchange rate is actually having a negative impact on retail sales as well. There has been enough of a swing in tourist numbers to have some impact on holding back what's been going on in the retail sector. Of course, the exchange rate has been holding back other sectors, as I pointed out, the manufacturing industry. It's also been holding back education exports. If you flick to the next slide, But it's worth keeping in mind overall that even though retail sales has been weak over the past year, households have actually still continued to consume at a little below their average pace in terms of growth in that consumption. So household consumption has actually continued to rise. This partly reflects that households have shifted what they're spending on. They're spending less on retail goods and they're spending more on services, but they're also spending more on online and transport associated with that. Again, I think this is partly a reflection of what's going on with the exchange rate. The exchange rate is allowing households to purchase more online from offshore providers of goods, and of course households are doing a lot more travel than they have in the past and therefore doing a lot more of their spending offshore. This once again gives some illustration of that the Aussie dollar is actually doing a fair bit of the work in terms of that adjustment, that transition we're seeing from an economy that has a lesser mining share to having more of a mining share. And of course that leads, as I say, to the overall idea that the areas that are going to be able to thrive the most are those that are going to be able to most quickly adjust to the shift we've seen in the Aussie dollar in terms of its level, and dealing with that higher level of the Aussie dollar is one of the key things that businesses need to do. Of course, some business models, as I say, don't deal well with that strength, but as it persists, businesses will continue to adjust to the higher level of the dollar. If you flick to the next slide, this shows, once again, in a similar sort of way to what Saul was showing, what's happening in terms of employment across a selection of industries. One thing that is clear is that the very sensitive industry, which is very sensitive to the exchange rate, the manufacturing industry, has been in decline. It's interesting that retail hasn't actually seen very much of a decline in its employment until recently, although it has leveled out. And then, of course, you can see the other areas of the economy that are potentially less exchange rate sensitive, or indeed the mining industry, which is very much driven by what's going on in commodity prices, have continued to grow. If you flick to the next slide, it makes a similar point in some ways to the one that Saul made. It's the range of unemployment rates across the states. Across geographical regions, we are seeing divergences, but it's important to keep in mind that actually, if you look at the range, that red line is the range. It's not actually at its average level, so we're actually seeing less divergence now than we have done on average in the past, and that second dashed line shows the average over the past decade. So even in recent history, we're not yet in a position where we're actually seeing more divergence across the economy than normal, although I would add that I think you should expect that you will see further divergence given the continued strength of the Aussie dollar and our expectation that it does stay strong. And even though commodity prices have peaked, they are still likely to stay stronger than they have been in the past, as well as the fact that, of course, there is a mining investment boom continuing to play out, and it really does look as though it's relatively unstoppable. So this is going to be something that continues to drive strength in those areas that are most exposed to mining and weakens other areas of the economy. We'd expect this divergence to probably get worse in the near term. Nonetheless, and finally, before we go to questions, this last slide shows the unemployment rate as it currently stands. Although it's ticked up in the last few months, it is really worth keeping in mind that long history. The unemployment rate is still at very low levels when you compare it to history, and at 5.2% we are pretty close to full employment. I don't want to take up too much more time, so I'll flick back to James.
Excellent. Well, thank you very much, Paul Bloxham and Saul Eslake, for those presentations, which have some common themes, but actually drew out quite different measures and some very interesting observations from both of you. I have many questions, so I want to get going on those questions straight away. And the first is from Mark Sullivan, who asks, and I think this would pick this up, first of all, with you, Paul, because you had some direct material to this effect, which is, what are the areas inside the Australian economy which will most quickly adjust to the higher dollar? I think one of your slides certainly pertained to those that hadn't adjusted so well, manufacturing, etc. But Paul, would you try to give some forecast of what sectors of the economy will adjust best?
Well, I think that what we're going to see is the sectors that really do struggle to adjust to the exchange rate are the ones where you have a direct international component involved, and tourism is one. I think manufacturing is another that is really likely to struggle. But things like the retail industry, really, I think over time we will see them adjusting to a newer business model. They will start to make adjustments because they'll be forced to. Either you stay in business and you adjust, or you go out of business. business, and part of that is really adopting the online space more actively and finding innovative ways to make to allow people to both use that online and be able to, and obviously for local businesses to be able to make money off of that. I think that's going to be an increasingly important part of the retail of what households do in terms of their consumption behaviour, in part because of the technology that's out there, but also, and of course that allows the households to be able to access global consumption markets. But also in part because of the strength of the Aussie dollar, and if that persists, it will become the case that households will be able to more actively use those international markets. Now, retailers need to really get it together and compete with that. I think the other areas would be ones where things are not exposed to the exchange rate so directly, and those are the non-traded goods in the economy.
Pick up, Paul, from that, and let's all maybe perhaps come in here. We've talked about retail, Saul. Are there other areas? Tourism obviously is one which is in the sights, if you know what I mean. Education also. Are there any obvious areas where you think there is a potential useful adjustment to the exchange rate?
Well, they're the main ones: manufacturing, retailing, tourism. Not so much other areas of education, aviation, and any other trade-exposed, non-resource related sector. I mean, some of the ones that can do well out of this, and there, I think in the general debate hasn't been sufficient awareness that there are parts of the economy that will do well beyond simply mining, include obviously the engineering construction sector that's going absolutely gangbusters. That's partly reflecting infrastructure spending by some state governments as well as mining construction activity, but that's certainly very strong. Professional, scientific and technical services, which is a not insignificant area of the business services sector of the Australian economy. Likewise doing particularly well. There are areas of the equipment hiring sector that are doing quite well. The financial services sector is continuing to do quite well, although I suspect many people will have some questions as to how the banks in particular are going to sustain the rates of growth in their core business that they've been able to achieve over most of the last 20 years. But as I say, and as is implicit in the phrase two-speed economy, there are sectors that are going to do relatively well as sectors that are doing poorly. Part of the problem is that we seem to, in Australia, have a view that there's something inherently more noble about activity and employment in manufacturing in particular than in parts of the services sector, and we don't get much data on important parts of the services sector compared with the frequency that we get them on retailing, manufacturing and housing.
Yes, okay, thank you, Saul. A question from an Emily Williams who's asking about whether the recent fall in commodity prices will actually cool the split that we are seeing, by which she means the two-speed split. Paul, will the cooling off of metal prices, iron ore prices, etc., coming down quite severely in recent weeks, will that actually ease the separation of the two speeds, if you like, between the two regions?
I think to some degree, yes. If you look at charts of the commodity prices and the exchange rate, they seem to have an uncannily strong positive correlation. So if commodity prices do fall further or come down to lower levels, you'd probably expect the exchange rate will weaken a bit from here. And if that were the case, obviously that puts less pressure on those that are exchange rate sensitive, and so you'd expect that there might be some adjustment back. But I wouldn't get too excited too quickly, because I think commodity prices, one, will probably still stay at pretty high levels. Two, much of the investment that's happening in the mining industry has actually already gotten started and really got triggered at lower hurdle rates than the current level of commodity prices. So that investment's going to happen irrespective. And if that investment's happening, it is along the way somewhat crowding out some of the other activities, in part via the strength of the Aussie dollar, in part obviously, in part also because the Reserve Bank is more likely to keep interest rates higher than otherwise in order to keep the other parts of the economy contained while that mining investment boom is happening. So look, I think you can certainly argue that commodity prices coming down a bit does help. in terms of a bit of a swing back towards the bits that are not the non-mining economy. But I still think we're in for a period where you're going to find that the economy is still going through a period of transition nonetheless.
Okay, thank you. Saul Eslake, subject close to your heart, productivity. We have a question from a Tim Kovas who asks, what can governments, and I presume he might mean state governments, do to enhance productivity in the states that are at the wrong end, as he puts it, the wrong end of this two-speed economy?
Well, my starting point for answering that question is to make the point that productivity growth happens as a result of the decisions that are made by the managers of individual enterprises or workplaces to organise work in ways that hopefully mean greater output produced with the same resources of labour and capital, or the same output produced with less labour and capital, or alternatively by allowing factors of production, labour and capital, to migrate from firms that can't use them efficiently to firms or industry that can. So a big part of the answer to the question that Tim has asked, what can governments do to facilitate productivity growth in those areas of the country that are at the wrong end of this two-speed economy, is to do whatever is necessary or to stop doing things that inhibit the ability of managers of firms and workplaces to reorganise work in ways that will improve productivity, or to facilitate the movement of labour and capital out of low productivity uses into high productivity uses. Now, that in many cases, though not all, means either less unnecessary regulation, and I underscore unnecessary because I'm not advocating the complete deregulation of everything. We know from the financial crisis that inadequate and insufficient regulation can have very unpleasant consequences, but there is a lot of regulation that unnecessarily and pointlessly inhibits the ability of firms to reorganise work in ways that would lift productivity. And there's an awful lot of public policy pressure coming in Australia at the moment. The most recent example was the decision yesterday by the opposition to advocate the reversal of the onus of proof when it comes to anti-dumping cases. I mean, perish the thought that most politicians are falling all over each other to assert how readily confronted with rising living costs, and then the opposition wants to penalise companies for selling goods to consumers at cheaper prices. And how crazy is that? But what it illustrates is the amount of political pressure there is to resist structural change, including the movement of labour and capital from low productivity uses to high productivity uses. And I guess what I'm saying is that sensible policy on the part of either the federal government or state governments here would actually facilitate structural change both within individual workplaces and across industries rather than seek to impede it. Now, obviously, well-targeted programs of spending and investment in skills and infrastructure can play a useful role here, and I would argue so too winding back a lot of the regulation that's been enacted by governments over the last 10 years or so, with the idea that it's both desirable and possible to eliminate most of the risks of being alive in the first part of the 21st century, something which of course I don't think you can eliminate, but a lot of regulation and legislation has been implemented out of the belief that you can and that you should. A lot of that regulation, and I think of regulation enacted in the name of so-called security or improving standards of corporate governance and the like, has simply added to costs and slowed things down without producing anything like a commensurate benefit. The less of that we have going forward, and indeed the greater effort we have to unwind what we already have, would I think be very helpful to the cause of improving productivity.
Okay, thank you, Saul. Yes, well, it's certainly a time, and we have on many levels governments making attempts to improve the situation, and to some extent we know in Australia we are insulated from the worst effects of the crisis that is continuing, and we see European governments struggling so desperately to get something rolling these particular weeks. One of the questions from Frank Palmer here I might address to Paul Bloxham. It's something that Saul alluded to in his presentation, which was about the fact that perhaps we have a two-speed economy for some time. Frank asks, is the two-speed economy really here to stay, or is it a passing headline? He says. Paul, was it always a two-speed economy, or is this something that is a genuine structural permanent change we're facing?
I think it's pretty reasonable to argue that Australia's economy is always multi-speed. You know, if you just look back for the past decade and as a sample, I mean, around the turn of the decade, we had house prices rising in Sydney and New South Wales. The last decade, New South Wales was doing was very strong. We had the Sydney Olympics, of course, and there was a lot of complaints from the West that interest rates were being set for the East. They were too high, and then of course the house price boom came to its end in Sydney. We saw commodity prices rise very strongly, and that drove a boom, the first stage of the boom in Western Australia and Queensland. And then we had the reverse happening. We had the people in the East complaining about the strength of how high interest rates were in the other parts of the economy. We're now in a position where the global financial crisis seemed to have arguably its largest effect on Queensland and Western Australia in terms of softening things up in those states a bit. And now we're about to go back in reverse again, where the mining investment boom pushes along Queensland and Western Australia, while New South Wales and Victoria probably slow down, having done actually quite well through the global financial crisis. The bottom line is Australia really is an optimal currency area, unlike Europe. We should actually have one currency, but it is certainly the case that we always have divergences across the economy, and that there is some management required. So my view would be that the multi-speed economy is here to stay. Is it going to be any larger? Are the multi-speeds going to be any more divergent than normal? I think that basically the slide I showed establishes that as yet we're not there. And it's quite possible that, given we're seeing now the global financial situation play out, and that having an impact on slowing the economy as a whole to some degree, that we actually don't necessarily see a lot more divergence across the economy in the next couple of years than we have historically seen.
Mm-hmm. Okay, but I suppose it is the case that it seems to be an issue of live debate more than it has been in the past. This is why we're having our webinar on the subject today. I want to address a question from Tim Diamond, which has come in. It's a very interesting question. He says, according to the Big Mac Index, that's this the price of a hamburger around the world, the Australian dollar is overvalued at the moment, and it should be 85 cents US. Is history a useful guide to the value? Saul, I think one of your charts did talk about the changing nature of our relationship on that particular axis with the US. Is history a guide at all? I know it was 75 cents since the float in the 80s, but does that really mean anything anymore?
Well, I think Paul's long-term chart of the value of the Australian dollar going back to the turn of the 19th century was very instructive in terms of getting a handle on where the Australian dollar is compared with previous periods when we were experiencing booms like the one we're at the present. It's a rather different impression from the one you get simply by looking at the performance of the Australian dollar since the float in December 83, for example. I guess it's obviously true that on simple purchasing power parity-based measures like the Economist Big Mac Index, the Australian dollar is overvalued. My understanding of the history of many markets is that at almost any point in time, an asset is going. It's a very rare occasion when any asset, be it a currency, a bond, property, shares, are actually at fair value. They might pass through it on the way from being overvalued to being undervalued or vice versa. But it's very rare that they're actually at what a model would suggest is fair value and that they stay there for any length of time. It would stand to reason, I guess, from the analysis that both Paul and I have presented, which highlights the role that the currency plays in reallocating resources from low productivity uses to high productivity uses, thereby helping to accommodate the expansion of the mining sector, a high productivity sector, in a non-inflationary way, that you'll go through a period in which the Australian dollar's overvalued by almost any metric as it is now. And that may persist for some time yet to come. I think Paul touched on this in his answer to an earlier question, that if the fall in iron ore prices over the last few weeks or months is a major turning point in the commodity price cycle if it continues, and it's paralleled by the price of other significant commodities like coal or LNG, then the Australian dollar will probably decline some from where it is and may head back closer to model-based estimates of fair value. But if that doesn't happen, if this is just an adjustment in the longer-term picture, and I think that's probably more likely, then the Australian dollar will remain overvalued for some time yet to come.
Okay, just before we go to the next question, so just to zone in on something you said there, what are the model-based estimates of fair value so people might know what they are?
Oh, look, they vary from the one which Tim quoted of about 85 cents. I've seen other people suggesting that based purely on commodity prices and inflation differentials, the Australian dollar's fair value is around 90 to 95 cents. On the other hand, unless things have changed in the last few weeks, my former colleagues at ANZ were saying that fair value for the Australian dollar might be $1.20. So there are almost as many answers to the question what's fair value as the Australian dollar as there are models designed to estimate it.
Oh, what a pity. It would be much easier to chart your currencies if the spectrum was a little bit tighter. Okay, Paul, a question from Ben Chervin says that Paul mentioned the mining boom as being unstoppable, Paul Bloxham. He asks, do we have any indication of how long the mining sector will enjoy these high levels of growth and output and perhaps enhanced productivity? Is there any way we can reasonably estimate how long that could, all those useful factors will continue for mining? Paul?
Yes, well, it's an interesting question, and I think it's an important one. The point I was making was the pipeline of mining investment that has already commenced is enough support for that industry to become a larger share of the total, continue to become a larger share of the total over the next couple of years, and then to maintain that for a while. Just given the size of the project, the number of projects that are out there, I think the government estimates that there's something like $430 billion worth of projects that have already started. That's about 33% of everything we produce in 1 year in this economy. Of course, you cannot produce that. You cannot have one sector jumping from being around about sort of 8% of the economy to being 33 in any one period. It takes multiple years for it to happen. I think, you know, in order to establish how long this will play out, it seems like a reasonable proposition that this will be at least the next 2 or 3 years in order to complete those projects that have already started. Now, it's very important to keep in mind that that's not actually going to continue to necessarily contribute to growth. We're going to see a step up in terms of the share of mining investment in the economy, and then that will continue in terms of its share of the economy. It doesn't mean continual growth in investment. It actually means that you get a step up in the level as a share of the economy. It will probably ramp up over the next, I mean, both my estimates and Saul's estimates show it ramps up quite quickly next year, and then you'd expect as a share of the economy that it probably levels out or comes down a little bit from there over time. But I guess the real thrust of the point is there is so much in the pipeline that it actually does end up being, it will become a larger share of the economy and stay a larger share of the economy for a number of years. Of course, if you want to try and estimate when it comes down or whether there's more that comes into the pipeline, that really is highly contingent on your view on commodity prices. I think it's reasonable just to really get out 1 to 2 years from now and say mining's going to be a bigger share of the total. I think one more point would be the government's estimates suggest that next year's growth, over about 2/3 of next year's GDP growth, comes from this the mining investment that's already in the pipeline, that's already happening. So it is a big story for 2012 and at least 2013.
Yes, as you say, Paul, there is immense momentum in the mining investment, and the scale of some of the projects, Olympic Dam, the Pilbara projects, etc., are so vast, and their flow-ons are so terrific for those regions that it is to some extent genuinely unstoppable. We're talking all the time about mining, which is a sort of in terms of the two-speed economy, that's the fast speed. Many of the questions I see on the screen are to some extent about the slow speed, that is about the manufacturing side. I'll just pick up one question. It's from a Charlie Carter, who says that why is our manufacturing industry such an emotional topic when your data shows that despite all the support it receives, it's on a long-term decline and makes up only a very small part of our economy? So why is it such an unique in its response?
That's a very good question that Charlie's asked, and indeed it's one I asked during my presentation. Australia is in some ways guilty of what others have described as manufacturing fetishism, the belief that there's something inherently more noble about manufacturing than other forms of economic activity. Now, don't get me wrong, manufacturing's important. And I'm not suggesting otherwise. Manufacturing does have important forward and backward linkages to other parts of the economy. It can be enabling. Some people say it is of national security significance, although whenever I hear the word security appended to any advocacy, I'm always instinctively suspicious of the motives behind it. People seem to be more upset about the loss of manufacturing jobs, e.g. at BlueScope Steel, than at the loss of a similar number of jobs in the services sector, e.g. at Qantas or at Westpac. People seem to think it's of national importance that a large number of people work in manufacturing, even though typically they're not all that keen for their own children to be working in manufacturing. So I don't know quite what it is, but people think, even think back to Kevin Rudd saying he didn't want to be Prime Minister of a nation that didn't make anything, and by thing he meant something you could drop on your foot, a good, as distinct from a service, even though a service might be more valuable. I mean, I don't think Australia's well served by this. Manufacturing fetishism was what gave us 80 years of ever-increasing protectionist trade barriers, and it wasn't until we started to bring those down that Australia actually began to improve its economic performance. And the same manufacturing fetishism, if it overly influences public policy, is going to complicate, to all of our detriment, the management of the mining boom.
Okay, thank you, Saul. A very useful observation. Yes, I suppose if you didn't include software, maybe can you drop software on your foot? I don't think so. That's
you
the
can
issue.
drop a disk of it, or the instruction manual on your foot.
It's sentimental, I expect, to some extent. Paul, can I have some very interesting questions coming in? They're rather different, so I'm just going to spin through one or two here if I could. This is a very interesting question from Carmel Collins, who asks, if it's a two-speed economy and the mining states are racing ahead, how come Brisbane house prices have fallen hardest in the country? I'd like both of you to quickly answer that one. Paul.
Well, I think the main answer is that in mining boom Mark I, both Perth and Brisbane saw very large increases in leverage, and that pushed up house prices a lot during that episode, during that period. At one point in time, house prices in Perth on average were actually higher than those on average in Sydney. And what we've seen is we've seen some of that leverage unwind. We've seen the global financial haven't yet seen the reverse, where income has started to flow back into those markets to put upward pressure on house prices in those areas, because they're still correcting from that earlier episode of run-up and that earlier episode of increased leverage.
So, Saul, do you concur with this broad theme?
By and large, although I'd just make the additional point specifically in respect of Brisbane, that Queensland is itself a two-speed economy. I mean, the standard characterisation of the two-speed economy that says WA, Northern Territory, Queensland booming, southeast corner stagnating is a gross oversimplification. And within Queensland itself, while the mining industry is doing well, partly because of the difficulty the coal industry is having in recovering from the floods and cyclones of earlier this year, it's not doing as well as expected, while Queensland also has quite a bit of other sectors that are adversely affected either by some of the resources boom's side effects, such as a strong $8, tourism, or industries that are adversely affected by the weakness in retail spending. Queensland has proportionately one of the biggest retail sectors in the country. So, and Queensland is also, southeast Queensland in particular, suffering from a substantial fall-off in migration from the southern states. It's now filtered down to the southern states that Brisbane has the worst traffic jams in the country, and that Brisbane has relatively high housing. It's not as pleasant a place to live as it might have been 20 years ago relative to the rest of the country. And a lot of the southeast corners industry has been, or economy has been, built on an ever-expanding dwelling construction sector. So within this kind of broad depiction of north and west doing well, southeast doing badly, there are some interesting regional variations and permutations, and one of those is, in addition to the factors that Paul mentioning, making the southeast Queensland property market look rather soggy.
Okay, yes, all right. Now, entirely separate question, which is on currencies, and I've avoided some of the more specific questions on currencies till now, but let's have a go at this. Anthony Duncan asks, the euro is an important rate for our economy, directionally. Where could that rate go over the next 5 years? That's one hell of a difficult question, I would imagine, Anthony, since we don't even know if the EU will be intact in 5 years. But let's put the question to the panel members. Paul, would you like to take it on first? The euro and the Australian dollar's relationship with it. Direction?
I think it's certainly one of the more challenging questions because, as you point out, we're still deciding whether the euro will still be around in 5 years' time. What we're faced at the moment, I think, globally is the ugly contest that's going on between the euro and the US. At the moment, I think is the euro's looking worse of the two. I'm hesitant to sort of put any particular figures on it, but I think it's quite fair to say that my view is that the Aussie dollar is going to stay relatively strong, certainly relative to the US dollar and to the euro, on the back of the fact that we just don't face the sorts of problems that they have there in terms of our fiscal position, on the back of the fact that we are in the part of the world that is most dynamic and that is emerging, and of course that we are tied into the Asia and China story, which is one that looks as though it's going to be ongoing and it is an unprecedented change.
Okay, we might just leave Saul. We're just running out of time, but I would like you to pick up on that same issue, and even if you would hazard as a guess as to say whether we will have a euro in 5 years' time. What do you think?
Well, I was going to say in response to the other question that I haven't been in the currency forecasting business for about 2 years and 3 months, and I'm not going back into it for another month, so I was going to duck that question. Look, I think the euro will continue to exist, and the reasoning behind that is that the euro is the capstone of what's fundamentally a political project, not an economic one, of building ever closer European integration. A lot of people outside continental Europe, and I include the British among this, simply don't get the point that the overwhelming drive behind ever closer European integration is not economic integration per se, but rather to break what had been a cycle going back at least to the 30 Years' War between 1618 and 1648, whereby at roughly 50-year intervals, one big continental European power would invade and lay waste to the territory of many of its neighbours and kill a lot of its people. And Europeans, because of their experience of that cycle, most recently in the first half of the 20th century, have been willing to pay almost any price to avoid repeating it. And for all of the many failings of the EU as a bureaucratic organisation and the euro as a currency zone and all of that sort of thing, that desire to avoid the conflagrations that used to occur in Europe at 50-year intervals roughly over a 300-year period is a pretty impelling reason why the European project hangs together and why the euro as the capstone of that still has such extraordinary support from large swathes of the European population. I mean, fundamentally, this is why Germans are still willing to pay high taxes so that Greeks don't have to pay all of their debts off and can retire 5 years earlier than Germans are allowed to.
Well, thank you for that, Saul. Look, I think it is a positive note, actually, to wrap up. We're running out of time, and it is a very interesting historic point that the wrangling we see in parliaments is actually a long, long way from the wars that preceded them not so very long ago in Europe, and to that extent the problems aren't anything as dire as were faced once upon a time. Thank you very much to both of you, Paul Bloxham, Chief Economist for HSBC, and Saul Eslake of the Grattan Institute and soon to be of Chief Economist of Bank of America Merrill Lynch Australia. I would like to say that we had several, among the questions, we had several comments from our viewers complimenting you both on the quality of the presentation and the graphs, and thank you very much for that. Thanks also to our sponsor who made this event possible, Citrix GoToMeeting, and finally thanks to you for listening and attending and your involvement in today's event. We do appreciate it and your continued support of our publication. You will be sent a link to the recording tomorrow, and please take the opportunity to provide us with direct feedback about today and send us some topics you might like to see covered in the future. We do listen to all the feedback, and I hope you're finding these sessions informative. From James Kirby at Business Spectator, thank you and goodbye.